Hey, what's going on, everybody? If you're in the multifamily or commercial real estate space, you're probably familiar with the term cap rate. Either that or you've heard it before. But what exactly is a cap rate? That's what I'm going to break down in this video. My name is Tita Dambuya. I'm a multifamily owner operating commercial real estate consultant. In today's video, I'm going to break down what is a cap rate, how do you calculate it, and how it's used and what the limitations are. It's something that's very important and it's fundamental for anybody that wants to be in the commercial real estate industry. So let's get into it. All right, first, so what is a cap rate? So the cap rate or capitalization rate is going to be the rate of return of a property if you bought it unlevered, meaning if you bought the property without any type of debt, what is that return, your return on investment if you bought the property that way? The way to calculate it is going to be the NOI, which is your net operating income over your value. So your net operating income is going to be your revenue minus expenses, and then the value is often going to be the purchase price. So let's get into an example of what that looks like. Let's say you have a property that's generating $100,000 in NOI annually, and the purchase price or the value is going to be $2 million. That means you have an NOI of 100,000, purchase price value of 2 million, and your cap rate is going to be calculated as 5%, which is 100,000 over 2 million. So what does a cap rate actually tell you? So a lower cap rate is going to indicate a lower risk, stable asset. There's going to be like a core asset where it's already generating revenue, it's pretty consistent, and there's going to be a higher demand for that asset. All right, a lower cap rate is going to be like somewhere maybe 3 to 5% is going to be lower cap rate. A higher cap rate, which may be like 7% to 10% or higher, is going to indicate more risk, less stable, but at the same time, it's going to indicate a higher return potential. So these are going to be properties and assets in emerging markets, sometimes distressed properties, properties with some value add potential. So there's some upside associated with that property. So cap rates are used to characterize risk and desirability in the market. So markets with lower cap rate are seen as less risky and more desirable to investors. So markets such as New York or like LA, Chicago, they're going to have more investor demand because those are very stable markets. They've been built for years. There's a lot of population there. So if you acquire asset there, there's going to be a lot of demand for your asset. Higher cap rate markets are going to be seen as more risky and ultimately less desirable from an investor perspective because there's not as much demand in those markets from a prospective renter. So think of markets like not to pick on Macon, Georgia, but Macon, Georgia. Macon is maybe like an hour outside of Atlanta, is not as developed, not as many people want to live there. So the cap rates are going to be higher in that market because people aren't willing to pay as much for a property there. As I mentioned earlier, the cap rate is going to be calculated as the NOI over the value of the purchase price, meaning you're getting a lower amount of cash flow per dollar you're spending on the asset when you acquire it. Inversely, it means a higher cost for every dollar of income the property can actually generate, meaning people are willing to pay a higher premium for the cash flow associated with that asset when they're buying a property at a lower cap rate. Aside from the market itself, it indicates the value or demand for a particular asset class. For instance, office is not as very much in demand right now because of all the work from home. Therefore, a lot of the office cap rates are higher. They're like in the 7, 8, 9, even 10% cap rates. Now, if you're getting some value out of this video, please go ahead and like and subscribe so that you can be on the lookout and be notified when I drop any more videos. Now, how do you actually use a cap rate in real life? How do you use it when you're investing in a property? Or how do you use it when you're trying to speak intelligently to a broker or investors? So first thing is to understand how cap rates change. So when cap rates are expanding or increasing, they call it cap rate expansion. And that indicates that the environment in which you're investing is more risky, meaning investors aren't willing to pay that same premium that I mentioned. Either they're not able to or they're not willing to pay that premium, and therefore cap rates expand. When cap rates decrease, that's called cap rate compression. And that means the investors are seeing the market as less risky and they're willing to pay more of a premium. And in a cap rate compression environment, you see values go up and they're higher than they were before when cap rates were expanded. For example, in 2022, when the Fed started raising interest rates, the cost of debt went up, meaning that investors could no longer afford to pay the same prices that they paid before. That's in a period of cap rate expansion because prices started to fall as a result. So that's how you use cap rate to compare the value of an asset against the market. So if you're in a period of cap rate expansion, you want to make sure that you adjust for that because cap rates are going to be higher and you don't want to be paying for a property with a very low cap rate in a cap rate expansion period. You want to make sure that you're in line with the market so that you're not overpaying. Another way to use cap rate is when you're trying to compare assets that are different. So, you may have an asset that's of a different size or even a different asset class, but cap rate allows you to compare those and see which is a better deal. For example, a 200 unit property in the same market is likely going to make a lot more money or generate a lot higher NOI than a 100 unit property. But being able to analyze and compare the cap rates can tell you which one is a better deal. Now, let's look at the example that we had before with the 5 cap. So that's how people say it. 5 cap, 6 cap is a 5% cap rate. They'll call it a 5 cap or 6 cap, just so you understand how people actually use it. Now let's say that 5 cap is a 16 unit property. So at $2 million, you're looking at 125,000 a door. Now let's compare this to a 50 unit property with the same price per door of $125,000, but this property is bringing in $400,000 in NOI. Now, which of these is a better deal? So we can't tell which is a better investment because there's a lot of different factors at play, but we can tell which one is priced better just based on comparing the cap rates. So let's look at the 50 unit. So in this example, the price is 6.25 million. The NOI is 400,000, and that leads to a cap rate of 6.4%. So in this case, the 50 unit is priced much better because you're paying a higher price or a higher cap rate than on the 16 unit. So the way to look at this is the higher the cap rate means you're getting a better return or a higher NOI relative to your purchase price. So in this instance, 6.4% is higher than 5%, which means you're getting is better value. Of course, there's a lot of other factors as I mentioned. One may be older, one may be in a more emerging market, one may have more operational risk. We don't know all of that, but at least we can say that the 50 unit is priced better based on the cap rate. Now, the cap rate does have its limitations. So it shouldn't be used standardly as a return metric in most cases because it doesn't factor in debt. And most of the time, you're going to acquire assets with debt. So, for that very reason, it shouldn't be taken into consideration without taking into consideration debt as well. So, a lot of times, what you want to do is you want to compare the cap rate to the interest rate on the debt that you're going to use to acquire the property. And you want to make sure or check whether or not you're going to be in a position of positive leverage or negative leverage. If you want to understand better about what it means to be in negative leverage versus positive leverage, please go ahead and check out the other video that I did, and we're going to link that so you can check it out. But there I go into all the specifics of negative leverage and whether or not you should buy a property with negative leverage. In conclusion, cap rate is a great way to be able to calculate your unlevered return, be able to gauge risk and understand market conditions or where they are relative to the cycle, but it's not the only metric you should use. Now, if you got some value from this video, which hopefully you did, please go ahead and leave a comment, like, subscribe, be able to tell other people about the channel and what we're doing, and then drop in the comments what you wanna hear more about, if there's any other terms that you want me to go over. Till next time.